In March 2023, something unbelievable happened in the heart of American innovation. A bank trusted by billion-dollar startups collapsed in just 48 hours. Not because of fraud, not because of hackers, but because of fear, silence, and decisions made years earlier. This is the true story behind the collapse of Silicon Valley Bank, and why its lessons matter to every American, not just Wall Street. Silicon Valley Bank was not a small or unknown player. Founded in 1983 in California, SVB became the financial backbone of the US tech world. It banked nearly half of all venture-backed startups in America. From early-stage founders to publicly traded tech firms, SVB was where innovation parked its money. For decades, the bank grew quietly. It understood startups, it understood risk, and it made founders feel safe. By 2021, SVB held over $200 billion in assets. Money was pouring in as tech boomed. Startups raised record funding, and interest rates stayed near zero. But beneath the surface, a slow-moving thread was growing. To understand the collapse, we need to go back to 2020. When COVID-19 shut down the world, the US government and the Federal Reserve stepped in aggressively. Interest rates were cut to near zero. Trillions of dollars were injected into the economy. For banks like SVB, deposits exploded. Startups raised huge rounds of funding and parked that cash at SVB. But banks don't just store money, they invest Italiano. SVB made a critical choice. It invested billions of dollars into long-term US Treasury bonds and mortgage-backed securities, believing interest rates would stay low for years. At the time, it looked safe. Treasury bonds are considered one of the safest assets in the world. But safe doesn't mean risk-free. Then came 2022. Inflation surged to levels not seen in 40 years. Gas prices rose, food costs climbed, rent increased. The Federal Reserve reacted fast. In one of the most aggressive moves in history, it began rapidly raising interest rates. Here's the problem. When interest rates rise, the value of old bonds, like the ones SVB owned, falls. On paper, SVB was sitting on massive unrealized losses. Tabang wasn't insolvent yet, but it was vulnerable, and very few people noticed. At the same time, startups were burning cash. Tech funding slowed. Companies began withdrawing money to survive. SVB's deposits started shrinking fast. To meet withdrawals, the bank had to sell bonds. And when it sold them, the losses became real. In early March 2023, SVB announced it had sold $21 billion worth of bonds at a $1.8 billion loss. It planned to raise new capital to fill the gap. That announcement changed everything. Within hours, panic spread across Silicon Valley. Group chats lit up. Founders texted founders. Investors made urgent calls. One name echoed through the chaos. Peter Thiel. Firms connected to him reportedly advised startups to pull their money immediately. This wasn't a rumor. This was a digital bank run. Unlike the Great Depression, people didn't line up outside branches. They clicked. In one single day, customers attempted to withdraw $42 billion. No bank in history had ever survived that. By March 10, 2023, Silicon Valley Bank was shut down by regulators. It became the second largest bank failure in US history. Thousands of startups were closing. Payroll was due. Rent was due. Employees were scared. Many accounts held millions of dollars above the $250,000 FDIC insurance limit. For founders, this wasn't finance anymore. It was personal. The US government faced a dangerous choice. Let SVB fail completely and risk panic spreading to other banks, or step in. That weekend, intense meetings took place in Washington. On Sunday night, the decision was announced. The FDIC, the Federal Reserve, and the US Treasury guaranteed all deposits, even those above the insured limit. Markets calmed, but the damage was done. So what really caused the collapse? It wasn't just rising interest rates. It was concentration risk. SVB served one industry, tech, moving in the same direction at the same time. It was poor risk management. The bank failed to properly hedge against rate increases. It was regulatory blind spots. After 2018, mid-sized banks like SVB faced lighter stress testing. And most of all, it was speed. In the digital age, trust can disappear in minutes. The collapse sent shockwaves through America. Other banks saw deposits flee. Stock markets trembled. Confidence cracked. But it also delivered hard lessons. Here are the lessons every American should understand. First, no institution is too smart to fail. Even banks serving the most innovative minds can make basic mistakes. Second, interest rates matter to banks, businesses, and families. What the Federal Reserve does affects savings, loans, jobs, and stability. Third, diversification isn't optional for banks, for businesses, for individuals, and finally, trust is the most fragile currency in finance. Once it's gone, numbers don't matter. Silicon Valley Bank didn't collapse because of greed alone. It collapsed because of assumptions that the future would look like the past. And in America's financial system, that's the most dangerous belief of all. So now, the question every American should ask is this. If fear can erase a $200 billion bank in 48 hours, how prepared are we for the next one?